Uhum. Certamente. Isso. Já. Uhum. Jovem. Ok? Ebu. So, hello, good evening, everybody. It's a pleasure and an honor for us at CDPP to welcome here Alberto Musalem. Alberto is a friend of many of us here, but I'll go through the bio anyway, right? We all know it, but I have to do it. So Alberto is the 13th president and CEO of the Federal Reserve Bank of St. Louis, a role he assumed on April 2nd, 2024. He holds a PhD in economics from the University of Pennsylvania, bachelor's and master's degrees in economics from the LSE. He began his career as an economist at the IMF, where we were colleagues, then spent over a decade at Tudor Investment Corp as a managing director, partner, and global head of research. From 2014 to 17, he served as executive vice president and senior advisor to the president of the New York Fed, leading its integrated policy analysis in emerging markets and international affairs groups, and representing the bank on the BIS. He then co-founded the quantitative investment firm Evins Asset Management in 2018, where he was CEO and co-CIO. He has also served on the boards of Freddie Mac and Mann Group and taught at Georgetown and Johns Hopkins. Alberto, thank you very much for being with us this evening. The floor is yours. Thank you.
Thank you. Well, before switching to English, vou falar em português um pouquinho. É um grande prazer estar de volta ao Brasil e rever tantos velhos amigos e ex-colegas. Now I'll switch to English. So good evening. I'm very delighted to be back in Brazil and also see friends and former colleagues. I would like to thank the CDPP and Mario Mesquita for inviting me to address you today. Before I get started, I'd like to stress that these are my views and not necessarily those of my FOMC colleagues. Few questions in economics today draw as much attention as what artificial intelligence, AI, will do to productivity and what that means for monetary policy. Firms are investing heavily in AI and other forms of automation. Many observers expect that those investments to raise productivity growth durably, easing cost pressures and giving central banks room to keep interest rates lower than they would otherwise be. I am an AI and productivity optimist, but I recently argued that the evidence does not yet justify setting monetary policy on the expectation of higher productivity growth in the future. In those remarks, I examined how faster productivity growth could affect inflation and interest rates, drawing both on economic theory and the historical record. Today, I will focus on one aspect, the possibility that monetary policy does not merely respond to productivity growth, but helps to determine it. Let me preview where I will land. There is a case for tolerating somewhat higher inflation in the short run in exchange for faster, long-run productivity growth. The argument says that gains from growth could compound year after year and are potentially far larger than anything the smoothing of business cycles can deliver. But in my view, setting monetary policy easier than conditions would otherwise warrant in pursuit of higher growth would be a mistake. The size of the eventual productivity gains is highly uncertain, and the argument in favor of easier policy takes for granted the credibility of monetary policy. The most valuable contribution to long-run growth that a central bank can make is to supply the stable prices backdrop against which firms can plan the investment and innovation that fuel economic growth. The job of fostering productivity growth is better suited to fiscal and regulatory policy. When economists talk about the long-run prosperity of a country, the conversation almost always comes back to one variable, total factor productivity, or TFP. It captures how much output an economy generates from its combined inputs of labor and capital. When TFP rises, the same number of workers and the same stock of machines and buildings produce more output. TFP growth is the part of output growth that comes not from working longer hours or adding more equipment, but from better technology, smarter organization, and new ideas about how to combine capital and labor more effectively. Because it cannot be observed directly, TFP growth is usually measured as a leftover, the share of output growth that remains after accounting for the growth in measured inputs. That residual matters enormously. Over decades, differences in TFP growth have been the main reason why some economies pull ahead in living standards while others stall. TFP growth matters for the central bank too. It helps set the economy's speed limit, the pace at which output can expand without generating inflation. TFP growth also determines the level of interest rates consistent with stable prices. Given TFP's central role, it may be surprising that most macroeconomic frameworks treat the TFP growth rate as something that happens to the economy rather than something economic policies can affect. In the real business cycle tradition, technology follows an external random process. Productivity booms and slumps arrive as shocks from outside the economy, which simply reacts to them. The new Keynesian paradigm adds an assumption that prices are sticky, so that monetary policy can influence the business cycle. However, as with real business cycle thinking, the new Keynesian literature also assumes that technological change is exogenous. A central bank can smooth output and inflation around the economy's productivity trend, but cannot influence that trend. Interest rates leave no lasting mark on the supply side of the economy. TFP growth is exogenous, a gift or a setback that monetary policymakers take as given. AI's arrival is a good reason to revisit the assumption that productivity is exogenous. Consider activities that ultimately raise productivity: spending on research and development, adopting new tools, automating a task, launching a new firm or a product, and so on. Those activities require investments that depend on the cost of financing them. That is precisely the lever a central bank pulls when it sets interest rates. If less expensive financing encourages more spending on innovation and automation, then monetary policy does not merely react to productivity, it can influence it. Economists call this endogenous TFP, meaning productivity growth is partly an outcome of economic conditions, including the monetary policy stance. Researchers have built the idea in several flavors. Some consider automation that shifts tasks from people to machines, others factor in the creation of new ideas and products, and some take into account the entry of new firms that widen the variety of goods and services. These approaches share a common feature. The pace of technical progress is a decision, not an accident. There is empirical support for the impact of monetary policy on productivity. Using U.S. data over several decades, at least one prominent study finds that tighter monetary policy can measurably reduce innovation with long lags. The lost innovation shows up years later as lower output and lower TFP. Interest rate decisions, in other words, can cast a long shadow over the supply side of the economy. If productivity growth is partially endogenous, a central bank faces a novel trade-off absent in the textbook exogenous TFP setup. Leaning against inflation today may come at the cost of less innovation and slower TFP growth tomorrow. The tidy textbook result that stabilizing inflation also stabilizes the real economy no longer holds cleanly. Demand-driven disturbances can leave lasting marks on supply. What does this imply for how monetary policy should be conducted? Economic research points in two directions. On one hand, when policy influences innovation, automation, and firm entry, both fully optimal policy and simple interest rate rules tend to put more weight on stabilizing output. The reason is that supporting economic activity today helps encourage the investments that drive future productivity. The logic also makes episodes like the zero lower bound more costly than they would be if TFP were exogenous, because a prolonged downturn drags down innovation and technological adoption. On the other hand, automation can flatten the Phillips curve, the relationship linking inflation and economic slack. Firms automate more when low interest rates make investing in automation more affordable. More automation raises productivity and lowers firms' marginal costs. With costs less sensitive to demand, inflation responds less to slack in economic activity. A flatter Phillips curve therefore calls for stronger and earlier action when inflation is too high or too low, because any given change in economic activity induced by monetary policy affects inflation less. So considering the direct effects of monetary policy on TFP hands policymakers conflicting considerations, with some arguing for more attention to output and others arguing for more attention to inflation. How much any of this matters depends on the expected size of AI's economy-wide productivity gains. Estimates differ substantially. At the cautious end, one assessment considers only the tasks AI can currently perform and what they cost. It concludes that the technology will add only a fraction of a percent to TFP growth over a decade, barely a tenth of a percentage point per year. Another analysis arrives at something closer to 10 times that figure, on the order of 2/3 of a percentage point of additional TFP growth every year. Economic theory allows for an even more dramatic possibility. Suppose AI becomes capable enough to automate the research that generates new ideas, including the work of improving AI itself. The resulting feedback loop could tip the economy into a phase of accelerating growth. What drives these views is differing answers to a few open questions. How many tasks will AI ultimately take on? How fast firms adopt it, and whether it accelerates innovation itself. Put the pieces together, and a seductive argument emerges. Suppose low interest rates can coax faster productivity growth, and that faster growth eventually relieves inflation by lowering production costs. Then accepting a little more inflation now might pay for itself later. The potential payoff could be sizable. A long line of research holds that monetary policy's traditional task, that of smoothing the business cycle by steering aggregate demand, delivers only modest welfare gains because the cost to households of those fluctuations is surprisingly small. In contrast, even slightly faster trend growth lifts future living standards by far more than smoothing the cycle ever could. Perhaps then, the prize of even slightly faster growth is worth running some inflation risk to claim it. The trouble is that this reasoning takes the central bank's credibility for granted. The bargain only works because households, firms, and investors keep expecting inflation to return to target. That expectation is what keeps borrowing costs, wage demands, and prices anchored. A central bank seem to tolerate above-target inflation on the promise of a future productivity windfall can put the anchor at risk. Credibility once lost is expensive to rebuild. History suggests restoring it can take a long stretch of painfully high real interest rates, a high unemployment rate, and lost output. Once those costs are weighed against the potential productivity gains, it is far from clear that a central bank should pursue monetary policy that is easier than warranted in order to foster productivity growth. A further reason for caution is that our dual mandate is written in terms of prices and employment. It says nothing about raising the economy's long-run growth rate. A long tradition in economics holds that monetary policy cannot durably lift real growth, and that it does the most good by keeping inflation low and stable. Fiscal and regulatory policies are the levers that reliably support productivity growth. Matching each instrument to the goal it is best suited to serve is an old principle. So to close my remarks, let me connect all of this to the current environment. The U.S. economy has been resilient in recent months. The labor market stabilized with solid payroll growth and an unemployment rate close to its long-run value. However, inflation is well above the FOMC's 2% target, and the balance of risk is tilted towards inflation remaining above target a year or more from now. Against this backdrop, it is crucial that monetary policy put a meaningful restraint on underlying inflation, rather than tolerating somewhat higher inflation today to pursue productivity growth tomorrow. A central bank's most valuable contribution to long-run growth is to supply the stable crisis backdrop against which firms can plan the investment and innovation that fuels economic growth. Thank you.
Thank you very much, President Musalem. I'll start off, a segue from your remarks. Natural one is regarding monetary policy, of course. We just had a FOMC meeting last week. What are your thoughts on the meeting and its outcome?
So I can only talk about my own views. I can't talk about what other people did in the meeting. But what I'll say is that the federal funds rate is our primary tool for making monetary policy. And I expressed a preference at the meeting to raise the federal funds rate by 25 basis points. I did so for two reasons. The first reason is that with interest rates at their current levels, I judge, based on my staff's analysis and on outreach that we do, that the probability that inflation will be meaningfully above target a year from now or a year and a half from now is higher than the probability that inflation will converge back to our 2% target. The second reason is that I believe that earlier gradual incremental interest rate increases are preferable, less disruptive, less costly than potentially later more abrupt interest rate changes. So that's the summary of the meeting as far as I saw it. Yeah.
Thank you so much. Inflation, be it headline or core, has been running above target for quite some time now in the US and other countries, including our own as well. What are the risks and implications for this persistent overshoot of inflation?
So inflation is high. It's above target. When I look at underlying inflation, after looking at a lot of analysis that my staff does, I believe it's running between 2.5% and 3%, excluding all of the supply shocks. So just excluding demand and trend. Looking ahead, I see two scenarios. Really, there are many scenarios, but let's boil them down to two scenarios. Under one scenario, the supply shocks fade in the remainder of the year. Oil prices come down. The impact of tariffs fade. And the labor market continues not to be a source of inflation, which it isn't. And under that scenario, it is possible that inflation begins to trend back down towards 2%. To see if that scenario is materializing, I'd be looking to see monthly inflation rates slightly below 0.2. That would tell me, okay, we might be in this scenario. It's a plausible scenario. There is another scenario, though, and right now we're getting upward inflation pressure both from supply factors and from demand factors. So we have recurring supply shocks and we have persistent demand pressures. Both are contributing to inflation. And in that scenario, if things continue that way, it is possible that inflation settles between 2.5% and 3% or higher a year from now. And that's how I'm seeing the scenarios. The second scenario requires, in my mind, somewhat higher interest rates to address that.
So much. Turning now to communications. Once upon a time, the Fed didn't even announce its policy decision, right? The market had to infer from how the New York Fed was trading. Then things changed dramatically to where we are right now. Is the Fed being too transparent? Is communication in need of major overhaul? There is a task force to deal with that. What is your view on that subject?
So I'm very open-minded about the task forces. I think there's always room to get fresh perspectives on how you ought to be doing things, how you ought to be implementing policy. So I'm very open-minded. I'm looking forward to the suggestions and recommendations of the task forces. I'm equally looking forward to our own internal discussions once having received those recommendations and the decisions we will be making. So that's what I'm really looking forward to. In terms of communications, I think while I'm very open-minded, I think it's important that we land in a place that we continue to communicate what our framework is and what our reaction function as a part of that framework is. So I think our communications, I think the foundations of the communications ought to be communicate your targets very clearly and communicate the framework you are using to achieve those targets very clearly. We know that central banks that follow discretion and that don't communicate as often tend to generate higher inflation than central banks that follow rules or constrain discretion and communicate transparently. So I still believe in those foundational elements, and I'll be looking to different ways and different suggestions of achieving effective communications.
Thank you again. Going back to the dual mandate and policy, you mentioned supply shocks, but to what extent is inflation in the U.S. has been a result of supply shocks, or is there, the demand side as well, or a combination of the two? And what variables you use to disentangle between the two effects?
So as I said a minute ago, my team estimates that both are at play. We've had a sequence in a short period of time, in a year and a half. We've had 3 very large supply shocks. Each one of them in isolation would have been very large. We've had 3 very large supply shocks. And there might be a 4th one coming this fall, which is the El Nino effect, which is affecting already agricultural prices in different parts of the world. So we might have 4 supply shocks in the space of 24 months. So that's definitely playing itself through prices and through activity. At the same time, we have demand that is related to the AI expectations of a brighter future. So we have both consumption and investment in the U.S. being driven by that. Investment is directly due to optimism about AI in the future. We have a lot of CapEx investment in that. Consumption is being pulled forward from the future through the wealth effects that equity markets are discounting will happen in the future of this bright AI future. So consumption and investment are increasing, are growing at a very healthy rate, in spite of the lower than expected GDP growth in the second quarter. If you look at the PDFP, or the consumption investment part, they're growing faster than trend. So we have both supply and demand. Our team estimates that if you strip out all the supply shocks, which is a pretty conservative assumption to think that all the supply shocks are going to go to zero, if you put them all at zero, you end up that inflation is running somewhere between 2.5 and 3. So that is still above targets. That means that demand is still pushing inflation above target. And of course, we all hear the anecdotes, right? We hear that iPhone prices are going to go up because chip prices are high. We hear that electricity prices are rising at 6 to 7% a year, which is in the 90th percentile of history. In my district, I hear that construction companies are shipping their workers all over the country, and there's a shortage of construction workers because they are being used to build AI centers, and that companies are paying above union wages to those workers. So there is a demand effect as well. Something that you did not ask, but I will offer is, how to deal with a sequence of recurring supply shocks. Normally the textbook would say if you have one supply shock, you look through the supply shock and you deal with the second round effects. The reason is because monetary policy works with a lag. So by the time monetary policy acts, the supply shock is over.
so you can't get there in time. But when you have a sequence of supply shocks of this magnitude for potentially 2 years, it's not so clear. They just look through them. So that's something that I'm examining and that I'm studying, what to do.
Thanks so much. Very, very interesting. Turning to the other side of the dual mandate, what is your assessment of the state of the labor market? You just alluded to high demand for construction workers. Is this widespread? Is it more sectoral, concentrated? How do you see the labor market at this juncture?
Yeah, the employment side of our mandate, I feel is in a good place. The labor market seems to me to be balanced. It seems to me to be stable, and it seems to me to be around maximum employment. So when I look at the unemployment rate, it's around 4.2%. If you look at the distribution of what FOMC participants think the long-run unemployment ought to be, the numbers range between 3.8 and 4.5. So it's right in the middle of that long-run equilibrium. If you look at the payrolls growth, we'll see what the numbers say tomorrow, but payrolls have been growing more or less at the high end of what we believe is the break-even rate of job growth. If you look at the vacancies to unemployment ratio, it's been stable now for a while, maybe even rising a little bit, around 1%, around 1, which is call it a balanced path. If you look at unemployment claims, existing or continuing claims, they're at multi-decade lows in raw numbers. In percent of the labor force is much larger. The claims are even lower. And if you look at the wages of job switchers, they are growing now again at a faster pace than the wages of job stayers, people that stay in jobs. So that tells you the labor market is healthy. It's paying folks to move. There are some areas of concern. The long-term unemployment rate continues to drift higher. And the job finding attitudes, if you look at surveys of people's expectations of finding a job, continue to be low or drifting lower. So those are two areas of concern. But by and large, I think the labor market's in a good place.
Thank you so much. I think today there was a report about phone calls between the president of the Republic and the president of and Chair Walsh. I think there's this talk about threats to the independence of the Fed has been around. There was a legal challenge. How does it affect your job? All this talk about potential interference. How does it affect your job at delivering stable prices?
I am completely committed to independently deliver maximum employment and stable prices to the American people. So I tune out all that noise. I just focus on that job, and I observe that all of my colleagues are equally committed to that goal with integrity and independence. I don't have to tell you here in Brazil the importance of monetary policy independence. The debate is now wide open, and in the U.S., and there is a broad understanding that monetary policy independence is an asset, that it tends to improve well-being, that it generates lower, more stable inflation, higher, more stable employment, which are two things that we want. Monetary policy independence has to come with transparency and accountability, which goes back to your communications question earlier. The need to communicate clearly. I sense a broad support for monetary policy independence when I talk to business leaders around the country. I go to Congress often. I hear that in representatives and senators. And over the history of the Fed, Congress has always attached a value to monetary policy independence, and has protected the Fed from short-term political influence over time. So we're committed. I'm committed. My colleagues are committed, and I think there's a broad understanding of the value of it.
Thank you. Yeah, we know how that feels. The recent policy statement was, pretty similar or almost identical to the previous one, with the tweak in the communication about the balance sheet. right? From something like from reaffirm to continue. What is the reading of that? Is that just a style change, or there is a content in there? How do you think about the balance sheet in general?
So the balance sheet is one of our tools. Our primary tool is the federal funds rate, and there's a task force. One of the big questions out there is how to use all the policy instruments. So there's a task force that will be looking at recommendations on the balance sheet. We are beginning to look at options on the balance sheet. There are three variables to the balance sheet. There's the size of the balance sheet, the composition of the balance sheet, and the duration of the balance sheet. And you can affect different things with those variables. For example, by changing the duration without changing the size, you will change the duration that the public holds, but you will not change money market conditions, right? On the other extreme, if you change the size without changing the duration, you'll have an impact on money market conditions, but you might not have an impact on the duration outstanding in the public and therefore the monetary policy side. So these are all things that we're studying. I look forward to engaging with the task forces once they have recommendations, and I very much look forward to our internal discussions and decisions on this.
Thank you. Your career has spanned, public sector, markets, academia. You've been very, competent throughout your career at anticipating market reaction to policy moves, right? Given that background, what the Fed can do to, better indicate its policy to markets to make the communication more effective, avoiding the kind of volatility that we have been seeing, in recent times.
So I observe markets very carefully, as you said. I used to work in markets, so I take signal from markets. I think it's important that markets give us signals. I'll go back to the communications comment that I made earlier. I think there's a difference between forward guidance, which is some sort of commitment that a central bank makes to the market, a time-bound commitment, an outcomes commitment, a bias commitment. That's one type of communications. And that's very different to communicating what your policy framework is, so that folks can understand, well, if the economy is in this situation or this other situation, this is how the central bank may or may not behave in different situations. So I think communicating the second part, communicating your framework, guiding the market as to what your thinking is, what your framework is, what you're concerned about, I think is important. The markets can then make their own decisions without any commitment. But communicating the framework transparently, not just the objectives, not just the targets, but how you intend to achieve those objectives and targets is pretty important, I think.
Thanks. Again, on this area, one thing that annoys me and other former central bankers very much is that talk that it's priced in, so the central bank needs to deliver, right? It's priced in, they have to deliver. Basically, the market telling the central bank what to do. How do you react to that kind of statement?
When I was in the market, I used to love that statement. When in my current seat, I don't like it so much. I think we in the end need to do what is best for the American public and disregard markets. I shouldn't say disregard them, given what I just said, that I take signal from them. But you can't be, if you feel you need to not change policy because now is not the right time, you shouldn't act because the market is telling you to act or expects you to act. Similarly, if you think that now is the time to change policy in whatever direction, you ought to change that policy irrespective of what's priced into markets. So there are times, there are moments when it's okay to surprise the market. And in fact, in many academic papers, monetary policy is judged as monetary policy surprises. So that's when monetary policy is most effective.
Thank you so much. You mentioned the sequence of supply shocks, right? Wave after wave, right? You are, and a lot of uncertainty with which we are not terribly used to dealing, right? The geopolitical uncertainty. How does a central bank operate in that kind of environment? Is scenario analysis something that you think is interesting, working with multiple scenarios and factoring that in your decision-making process? Because it's a bit of uncharted territory, right?
So in my first speech in this job, which was a nerve-wracking moment for me, the first speech, come out, I made a case exactly for that. I said that my framework was one of scenario analysis and attributing, what the dual mandate would look like in different scenarios and attributing probabilities to those scenarios and communicating that to the market. So I, in my time in markets, I learned to think that way. As an economist, I've been trained to think that way, and I think that is a very effective way to think about what may be before you. Notice that at the beginning of our talk, I outlined two scenarios. I boiled down many scenarios into two scenarios and gave you two scenarios of how I think inflation may behave and what to do about it in those two scenarios. So that's how one has to behave. In terms of geopolitics and oil shocks, etc., I think the same applies. Yeah.
And how transparent should the Monetary Policy Authority be regarding the scenarios that it's envisaging? Is it something that should be fully communicated to markets?
This is a great question. I'll spend a little bit of time on this. If you look at the SEP, they already communicate many scenarios. In fact, it communicates 19 scenarios because 19 people have 19 different scenarios. They may be clustered around certain scenarios, but there are 19 different scenarios, 19 different policy paths. The trouble is that the SEP doesn't connect the dots, so the public cannot understand which scenario for the economy leads to what interest rate path. It is hard, but not impossible, to get 19 people to agree about one alternative scenario. Now, I should say that internally, when we're looking at the analysis at the FOMC table, we consider many scenarios, something like 5, 6, 7 scenarios of all kinds. So our process does consider that. We call them alternative simulations, and we consider how the economy should behave, how interest rates ought to behave, and how our dual mandate objectives ought to behave. So it is part of the toolkit. Yeah.
Thank you so much. Many years ago, when we started out at the IMF, was around the time of the famous, Greenspan irrational exuberance speech, right, at the time of the dot-com bubble, which has had economic fundamentals to it, right? How concerned we should be about the current situation in terms of the impact of AI on the stock market and stress points that might emerge from that, and stress points in the U.S. financial system or the global financial system in general?
So financial conditions and financing conditions, so prices and quantities, are very accommodative right now. If you look at prices of a lot of assets, they are elevated. The equity market specifically, earnings expectations by analysts are very high relative to history. Prices in markets are very high relative to those earnings expectations. Equity ownership is very high by households and by institutional investors. So, I am watching that. We are all watching that. The amount of financing to the economy is very abundant. If you add up all of the capital markets financing and all the banking financing to the economy, it has risen appreciably over the last year by about 4% of GDP. And in level terms is now close to where it was in 2021, when there was a big effort to extend financing to the economy after COVID. So I am watching all of that. We are watching very carefully the interaction between non-bank financial institutions and banks, which we regulate. And banks are well capitalized. They are liquid. They've just passed a stress test, but we're always monitoring those connections.
Thank you. I think there's been a lot of discussion about FX and FX intervention. I'm not going to ask you about that. I'm going to ask you about the dollar itself. It's still the world's reserve currency. Is there, a challenger out there? Is this something that is going to change, in your view, gradually or eventually suddenly? or are we, business as usual regarding the USD?
So the dollar is the domain of the Treasury. So I'm not going to answer your question directly. I'll just say the U.S. still is the highest growth large economy out there. It is the most innovative economy out there. All of the AI is happening in the U.S., for example. It has the deepest, most liquid capital markets. It has an effective rule of law. These are all underpinnings of a reserve currency, and I don't see those things changing. Yeah.
Thank you. I mean, you've been, in your one of the previous jobs, I mean, a lot to Basel, the central banking community. How do you see, central banks currently, their challenges in the global economy?
I think there are many challenges always for central banks, as you know. I see two things that are epical, let's say. One is since 2020, there have been many more supply shocks than in the previous 20 years or so. So central banks are learning how to manage to their objectives, whether it's inflation and employment, in a world of abundant supply and recurring supply shocks. How do you manage that? So I think that's something that central banks are coming to grips with. The other thing is not monetary policy, but it's the evolution of the payment system. The payment system is evolving, by big steps, very interesting steps in many directions, and central banks are, examining how to continue to be, providing value added in the new payments methods and rails that are being introduced. How to be, how to innovate, and I think that's an area of deep thinking and a tremendous amount of work in central banks right now.
Thank you. Coming towards the end here, I think one question that always comes to mind is the behavior of inflation expectations, right? And so I'd like to hear what are your preferred measures of inflation expectations, and how concerned are you about the fact that they may be, moving away from the target?
So I'm gonna challenge your premise there, your final premise. I think inflation expectations continue to be anchored and consistent with our 2% target. I look at all of them. It's not a satisfying answer, but you have to look at all of them. I look at surveys of households. I look at surveys of businesses. I look at surveys at different maturities. I look at all of the market implied metrics. I look at principal component decompositions of all of these metrics. So we look at all of that, and it still tells me that inflation expectations are anchored and consistent with 2%, in spite of the volatility that we experienced last week. That they remain anchored. I think it's important to distinguish volatility from levels, and the levels still remain anchored. One thing that I'm very focused on is we've now had 5 years of above target inflation, and we continue to have inflation challenges. Folks in my district, businesses continue to expect higher prices going forward. If you looked at the ISM data in the past week, both manufacturing and non-manufacturing, the prices paid component continues to be elevated. So there is fertile ground for inflation expectations to potentially become unanchored. Now, that having been said, I don't think that they're unanchored in any way, but we need to be very sensitive to the threat that they may be becoming unanchored. So I'm watching it very carefully. My colleagues are watching it very carefully, and we are all, well, I'll speak for myself. I am very attuned to the fact that to achieve our dual mandate objectives becomes much, much harder if inflation expectations are threatening to become an anchor. The ability to hit price stability and to hit the maximum employment objectives becomes that much more challenging and more costly. So we're observing them.
Thank you. Yeah, my premise was perhaps my Brazilian bias, okay, from experience. So, final question. We talk about different measures of expectations, different indicators of expectations, and what about inflation itself? Is there a preferred, measure of inflation that you like to look, or you look, all of them?
Same answer. You have to look at everything, as you know, as you did it at the Central Bank of Brazil. You have to look at them. There are times when some measures are perhaps more relevant than others. Right now, with such volatility in energy prices, I'm more focused on core personal consumption expenditures because to me it's the cleanest measure, that's what I'm focused on. But it doesn't mean that that's the only thing I'm focused on. Something that I've observed in the last few months is that core non-housing services inflation has been particularly sticky. So I'm looking at the services side also to see if the second round effects of the supply shocks of energy may be seeping in. But with all this volatility in energy, it's important to measure to focus on underlying inflation, which I think core PC inflation is a pretty good metric.
Thank you so much. We came to the end. President Musalem, thank you very much. Muito obrigado. It's been an honor.
Thank you, Mario. Obrigado.